Picture this. You finally decide today is the day. You open your brokerage account, click the button to start investing, and then you see it. Hundreds of funds, ticker symbols, expense ratios, Morningstar ratings, category labels you've never heard of. So you do what almost everyone does. You close the app. You tell yourself you'll research it this weekend. And then the weekend comes and goes, and nothing changes.
Here's the thing. That moment of freezing isn't laziness. It's completely rational. You were handed a wall of options with no framework for choosing. And I'm going to give you that framework today. This is slow money, real wealth. If this kind of practical money clarity is what you're after, hit subscribe and give this a thumbs up. It genuinely helps other people find it. Now, here's what most people don't realize when they finally get to the index fund stage. They think, I heard index funds are good. I'll just pick one. And that's right, but only partially, because not all index funds are equal. Some share nearly identical holdings, but charge 10 times more in fees. And that difference, which looks tiny on paper, silently drains thousands of dollars from your returns over time. Let's start with why you're even in the index fund conversation in the first place. Every year, S&P Dow Jones publishes something called the SPIVA scorecard. It tracks professional active fund managers versus their benchmark index. Over the last 15 years, 92% of active large-cap fund managers underperformed the S&P 500. Not a bad year, not a few unlucky managers. 92%. Consistently. That's the whole case for index funds right there. But that's the part everyone knows. The part you need to hear today is what's hiding inside the index fund category itself. Here's what most people don't realize. The fee difference between a high-cost and a low-cost index fund tracking the exact same index looks tiny. We're talking 0.03% versus 0.75%. That sounds like nothing. But over time, it is not nothing. It's the difference between arriving at your destination and arriving missing several $1,000s that were silently subtracted along the way. Let's look at the math. You invest $10,000 and it grows at 7% annually, the historical average real return of U.S. stocks. After 20 years, with a 0.03% expense ratio, you end up with roughly $38,000. With a 0.75% expense ratio fund tracking the exact same index, you land closer to $32,000. That's over $6,000 drained silently, not by a bad market, not by bad timing, just by fees that never appeared as a line item because they were subtracted before your return was ever reported to you. And this is where it gets really interesting. The fund that charged you more didn't outperform. It may have actually underperformed because of the fee drag. You paid a premium and received a worse outcome. That's the trap. Millions of investors are sitting in it right now without knowing it. So, what do you actually buy? The framework I'm giving you today covers 99% of what most beginning investors need. It's called the 3-fund portfolio, and it's been the gold standard in the low-cost investing community for decades. Fund 1. A total U.S. market index fund. One ticker, thousands of companies, from large cap to small cap. Fund 2, a total international fund. The U.S. represents roughly 60% of the global stock market. If you only hold U.S. stocks, you're ignoring 40% of the world's companies. Fund 3, a total bond market fund, which reduces volatility and provides stability when stocks fall. That's it. 3 funds. Done. Here are the specific low-cost options available right now. At Fidelity, FCROX for total U.S. market at a 0 expense ratio, literally 0, and FCILX for total international, also 0. At Vanguard, VTI for total U.S. at 0.03% and VXUS for international at 0.07%. At Schwab, SCHB for U.S. at 0.03% and SCHF for international at 0.06%. All of these are legitimate, highly liquid funds with billions under management. The differences between them are negligible. Pick one from your brokerage and actually invest. Comparing them indefinitely is how another 6 months disappears without you putting a single dollar to work. Now, let me tell you what to avoid. Sector funds first. These focus on a single industry: tech, healthcare, energy. The problem is your total US market fund already holds all of these sectors. When you add a sector fund on top, you're duplicating holdings and concentrating risk. You're not diversifying. You're doubling down on what you already own. Second, watch out for target date funds from the wrong providers. They sound convenient. Pick your retirement year and the allocation adjusts automatically. But some carry expense ratios above 0.5%, which defeats the entire purpose. Vanguard target date funds run around 0.08% and are genuinely solid. Others are not. Always check the expense ratio before you commit to one. Third, some actively managed funds use the word index in their name, but still have a team of managers making decisions and charging you for it. If the expense ratio is above 0.2%, look closer at what you're actually buying. You might be paying active management prices without realizing it. Here's why smart people still fall for expensive funds. Behavioral scientists call it familiarity bias. We perceive brand recognition as quality. A fund you've heard advertised 100 times feels safer than an unfamiliar ticker symbol. But the financial products with the biggest marketing budgets have the biggest marketing costs, and those costs come out of your returns. A friend of mine spent 3 years in a fund his company's financial advisor recommended at new employee orientation. He never thought to question it. When I asked him to look up the expense ratio, it was 0.72%. When we ran the 20-year math on his contributions, the difference was over $40,000. He switched funds within the week. Think of it like store-brand ibuprofen at the pharmacy. 2 boxes on the shelf. Same active ingredient, same dosage. One costs 4 times more because of the name on the front. Index funds tracking identical benchmarks are the same product in different packaging. Don't pay 4 times more for the box. Here are 3 steps you can take today. Step 1, pick one total US market index fund with an expense ratio below 0.05%. At Fidelity, that's FZROX. At Vanguard, that's VTI. At Schwab, that's SCHB. Step 2, add international exposure. Aim for roughly 20 to 30% of your stock allocation in a total international fund. Europe, Asia, emerging markets, the full global economy outside the US. Same criteria: low cost, broad coverage. Step 3, set your bond allocation based on your timeline and your real comfort with volatility. A simple starting rule: subtract your age from 110 for your approximate stock percentage. At 30, that's around 80% stocks and 20% bonds. Adjust from there based on how you actually feel when your account drops, not how you think you'll feel. That's the whole framework. 3 funds, a low expense ratio, broad global coverage. That's what separates investors who quietly build wealth over a decade from savers who stay stuck. You don't need more funds. You don't need sector bets. You need broad market exposure, international diversification, and a fee structure that isn't quietly draining your returns for 2 decades while you're not watching. Drop a comment below and tell me, which fund are you currently holding, or which one are you considering? I read every comment, and I might feature your specific situation in an upcoming video. If this helped you go from overwhelmed to actually having a plan you can execute today, that's exactly what this channel is built for. Hit subscribe. I'll see you in the next one.